Hi there. In this video I would like to show you a new live position that I have just finished recording. My name is Gery and I'm the Chief Options Expert at TanukiTrade. I had a bullish and neutral outlook in the market, and here you can see where the position started and where it ended. The structure was a call diagonal, and I was 19 days in the trade and made $290. And you will also see 5 adjustments in the position because I also used a hedge for protecting the call diagonal debit. And as you can see on the chart, there was a dip in here, so that hedge was pretty useful. You will see all these adjustments in this video. In this video, I would like to show you a new position that I have just opened on my trader account. Let's look around the SPX on the daily chart because I opened a new position on SPX. And right now what I can see on the GEX levels is that we are above HVL, which is the high volatility level. We are in a positive GEX zone or GEX profile. And right now the market is kind of bouncing back from this HVL level. The 68.50 is the current put support for the 30th of January, and the core resistance is around 7,000. And what I was looking for is kind of an upside trade, not very fast, not very directional, but I was looking for a very good reward to risk trade, and this is what I found. This call diagonal spread, which was filled for 75 bucks per contract. And the idea of this trade is that the market will go maximum to 7,075. That is the short strike of the call diagonal. Here you can see in TanukiTrade, this is the current price of the SPX. Right now, the position is around 0, and it has a very flat, a little bit positive, but flat delta. This delta becomes even more directional as time goes by because of the charm and delta decay or delta effect of time, which is called charm, whatever. So the idea is that SPX might go up, and if we are crossing above 7,000, it can create a positive upside squeeze, but I'm not expecting a very violent and very fast up move. And I like these diagonal spreads because they are pretty cheap, and it's a very cheap shot on the upside. But I only found this one with more than 3 weeks to go. It's a little bit too much. I like more 2 weeks diagonal spreads for SPX with a $5 difference between the short and the long legs, but this is what was found during my scanning for diagonal spreads. The downside risk is pretty small, but if we zoom out a little bit more on the upside risk, you have to notice that there is an upside risk much higher than the downside risk because of the diagonal spread. A diagonal spread is always a calendar spread and a short call vertical. So there is an embedded short call vertical in this diagonal spread. That's why there is a higher potential risk on the upside. I will definitely not hold on to the position until this break-even, and also these break-even lines move very dynamically because this is a time spread, and time spread expiration graphs do not stay the same during the life cycle of the trade. So we have to watch that and be aware of that. And let me show you the fills from my live trader account. The positions were filled for a 0.75 debit. As you can see, this is the sell to open leg, which is the short leg, and this is the long leg of the diagonal. There is only a 3-day difference between the two legs. I like this Friday-Monday expiration combination. So I will monitor this trade. Let's continue from here. It's the 14th of January. 6 days have passed since I opened the position. Right now what we can see that there is a clear gap down in the price of SPX on the daily chart. We went below the HVL line. Yesterday it was above it, and volatility was pretty slow or low at that point. And right now we are below the HVL line, and the put support decreased since my last recording. It was above around 68.50 or something like that. Right now it's 6800. So it means that there is more bearishness in the short term temporarily. Since we are below the HVL level, we need to think about hedging the position. Currently, this is the state of the position right now. As you can tell, this is a pretty forgiving position because the market is moving down and volatility is increasing, and still it's above money or up money because it's around $100 in an unrealized profit because the diagonal spreads were both around 75, and right now I could sell them at $1. And since we are below the HVL line, I started to hedge the position because we still have 2 weeks until expiration, so I can make more money with it if I stay into it and the market goes back up. Because if we look at the technical level, only the technical level, not the GEX level, but the technical picture, it shows that at this level there might be a bounce. I'm not sure if it happened because under the HVL line moves tend to be faster, so probably they will overshoot. The next support can be around 6,800, so that's why I put on a hedge for this position as 69.20 and 69.15 put vertical spread on the downside, which would definitely and totally hedge the position, because if the market decides to go further down, the maximum I will lose or not lose is $15 profit, because the whole thing will hedge the 4 diagonal spreads, because the 4 diagonal spreads cost $300, and this vertical spread, the maximum profit is 3.15 because the spread distance is 5 and the cost is 185. That's why the maximum profit of the vertical spread is 3.15. So if I only look at the vertical spread, you can tell that this is the maximum profit of the vertical spread if the market tanks. And since I spent only 300 for buying the diagonals, this is a complete hedge against the move. The only part that I need to be taking care of or watch carefully is this part, because if the market gyrates around this area, this whole thing, the value of that will sink and will go even further down. Because imagine that the market is not moving anywhere but stays here. If the market stays here and I do nothing, I do not adjust the position, it means that I will lose 300 on the diagonal spreads and I will lose 185 on the put spread. Because if the put spread goes out worthless and also diagonal goes out worthless, I lose both premiums. So that's why I need to watch for these movements around here and scale out from the positions accordingly. And we still have more than 2 weeks until expiration, so there is no rush into it, but I just wanted to hedge the position under the HVL line just in case something happens in the marketplace. Right now the market event risks are gone because yesterday was CPI, today was PPI, so these were market moving events and they were better than expected. So it might also happen that this kind of line supports the market and the market will go back up, but below the HVL line someone needs to be a little bit more cautious. That's why I bought this hedge, and I will show you the fill from my trader account. This is the debit 185. As you can tell, these are the strikes, so the hedge is on the position, and let's see how the market is unfolding from here. I will continue from here. 16th of January, we are on a Friday, and let's look around the market and what has happened since my last recording. My last recording was in this candle when the market went below the HVL line and turned into negative GEX profile for the short run. Then after that there was a gap up and a gap fill already, and today is an undecided day so far, and mid and inside day from the yesterday bar. So let's see how the position is doing. Right now what I did is I adjusted the position in a way that I closed out or scaled out 1/4 of the previous or original diagonal spread for 125. So it's a nice profit in a couple of days. I'm going to show you the screenshot of the fill, 125, and 1/4 of the diagonal spread was closed out or sold because I wanted to scale a little bit out of the position and create a higher downside protection. And also if the market continues to chop sideways, this hedge, I don't want to drag the position down. So this is the current position state. I also wanted to keep the positive data. It's kind of neutral right now, but still a little bit positive. And if you look at my previous hedge that was bought for 185, it's only 145 right now because the market went up from the point where I bought the hedge and scaling out from the position one by one. So if I analyze this trade and duplicate it again, here I can see the current price of the diagonal and can watch how they change. So this is the position right now. It's a nice profitable area on the downside as well and on the upside as well. So if the market shoots instantly to, for example, 7100, it's still a little bit above water, but we will see how the market unfolds from here. Right now, what I can see on the GEX level is still 7000. That's the highest core resistance. 6900 is a put support. We are just above HVL. And if you look at the current market moves, and then again, the market pinched down to HVL and then recovered from there. So this is kind of a narrowing move, so I'm interested where it will be resolved, probably on the upside, but we will see. So that's why I wanted to keep the hedge on, just in case, and scale out a little bit from the position. So let's see how this position changes in the next coming days. I will continue from here. It's the 20th of January, and as you can see on the daily chart of SPX, we had a huge gap down and the market did not stop falling since the market opened. We are below the 50-day moving average and very, very close to the 6800 level, which is currently the highest put support. So we have to watch for this put support if the market is holding here or breaking down even further. But as you can see on the chart that the put pricing skew has increased substantially since my last recording. And on the histogram, you see this level, which is pretty high compared to the past. We were even higher before, but this is a pretty high reading. And the 6800 is the put support. It doesn't mean that the put support will hold, because tomorrow there will be another event risk where the great leaders will meet in Davos. And if Trump says something very unusual, the market can also fall in a spiral tomorrow. So that's another event risk. This yellow flag will from now on mark the opening or start of the position. On Friday, I scaled out 1/4 of the diagonals. In hindsight, I should have sold more, but you know, trading is not about hindsight. And I wanted to show you what kind of adjustment I made today. Right now, what you can see is that this black part is a separator. And there is another adjustment I did today. I closed down the 69.20, 69.15 vertical spread because I bought for 185 and I could sell it for 290 because I was positioning a little bit more positive that I wanted to stay after a fall like that on the positive side because 6800 is here. And I thought that the market would stop in here. So that's why I closed down the vertical. So it means that if the market keeps continuing lower down, then I will lose $70. And I'm okay with that. And also I can sell some part of the diagonal still. And what was interesting is when the market opened around this area and even went further down, I could have sold the diagonals around the initial or debit premium I paid for 0.75. I did not do it, but the price was very stable despite of the fact that the market is falling. That's why time spreads are pretty good environment if the implied volatility is increasing, because then the whole time spread deflates and opens up and gets more worthy or higher in price. So actually this is what I did. Without the adjustment it would look like that, but with the adjustment this is the current state of the position. And here is the screenshot of the fill. It was sold for 290 and we will see if the market turns or not. And I still have 10 days in the position until expiration. I will continue from here. It's the 21st of January, and today Trump made announcements in the Davos conference that there will be a de-escalation in terms of military forces of Greenland situation. So he's kind of backing off from the military force using in the Greenland situation. So that's what the market is liking right now. We are above the 50-day moving average. And yesterday the 6800 was the put support in the weekly expiration. This is the second expiration next Friday, and put support is 6850, and if we can hold above the put support and gravitating back to HVL, then there might be a chance that we will bounce back to the previous high. So right now the market is positive and kind of bullish. Probably there are lots of short covering as well. I wanted to show you something which is probably interesting to see, is that yesterday there was a pretty high put pricing skew, and you see on the oscillator that the put pricing skew was pretty high yesterday, and these levels are very rare. So sometimes the market hits these levels in the past and then backs off. This is what happened yesterday. There was around 128, 130% of put pricing skew, and now it reversed back to 100. It's still a high value, but better than before. So the market reversed. Let's see how it will continue. And I will show you what happened to my position, because I had to adjust the position. I wanted to adjust the position. I closed 1/4 of the original diagonal spread for 75 cents because I wanted to take off all the risk from the table, because if I click in here, you will see that the maximum I can lose on the downside is making $5. So that's the maximum here. So there is no loss. On the upside there is a loss, but it's way, way, way above. So I don't care about it. It's absolutely no chance to go to 7,200 in like 9 days. That's not the context we are trading in right now. So what I'm looking at is around $165 in realized profit, or unrealized profit rather. And I would like to see how this goes, and watching the price of the diagonal spread moving on from here. So let me show you the screenshot of my fears from TradeHero. 0.75 was the credit. So half of the original diagonal position is still in the play. I will see how it will continue. And one thing you might notice that I changed the flagging of the opening candle, because this is a much better way to see it or mark the way when I opened the position. So I opened the position on the 6th of January, and since then I made a couple of adjustments, one diagonal closing, and yesterday there was a vertical close, which was a nice close because the market reversed back up, and today I closed another quarter of the original diagonal spread. So I will continue from here. It's Friday. Before I show you what kind of adjustment I did, just one note that in my previous recording I was incorrect about the opening date, because I thought it was the 6th of January, but in reality it was the 8th of January. So I changed this marking of the opening candle. So if we are looking at the GEX profile, the market is around the HVL line, so it's kind of undecided yet. But we are just a small bit above HVL in a positive GEX territory, and the put support did not relevantly change. The call resistance became 69.50 for next week, and since there is only 1 week until expiration, I wanted to scale out even further from the position. This is what I did. I did sell 1/4 of the position, the original diagonal, for 85 cents. And here you can see the feel from my TradeHero account. 85 cents was as a credit for selling this diagonal. So I just wanted to make sure if the market stays around this level or goes south, then I still can make money. I only have 1/4 left in the diagonal spread, but remember that I opened the position here. So all in all, the position has gone against me and still in a profitable state because of the hedge and because of the adjustments. So I thought that it would be safe to, leave only 1/4 of the position for next week. If the market goes up, that's fine. If it's not, then I will take this amount that it's here. If I move the cursor down here, you will see in TanukiTrade that the profit I would make if the market goes south is around 90, or not around, but exactly $90 with these adjustments. So let's see what next week brings. I will continue from here. It's Tuesday, and if you look at the daily chart of SPX, we can see that there is an all-time high actually right now. And we are pretty close to the 7,000 level, which is a core resistance, and probably there might be some kind of profit taking around this area because the market just shoot very fast to the upside. And since we only have 3 days until expiration in this calendar spread, I decided to close down the rest of the position, which was 1 quarter left. And here you can see the current position. It has around 280 unrealized P&L right now at this current state, and I closed down the last quarter for $2. I wish I had done the same with these ones because these were only 75 cents and 85 cents, but you know, this is how risk management goes. I never see the future, so that's why I have to manage the risk first. So this is the field from the trader account for 2 credit. And if I click in here, it will show you that all the positions are closed and there was a 290 profit done in this position. And one more thing I would like to show you what would have happened if I did not sell the vertical spread, the hedge. This would be like a value of that kind of part of the position. It would still be profitable, but this is a pretty dangerous place if the market is moving around here, because this will sink down here and dip very fast approaching expiration. So it was good to close this hedge down, and the market went just back up, and it created a $290 profit all in all. I hope you have gained some insights from this position management. If you have any questions, just let me know. Thank you for your attention. Take care. Bye. Thanks for watching. If you haven't yet, please subscribe and check out our other videos. You can always find us at the links in the description. Trade safe out there.